In many of my previous videos, I talk about market edge, where you need to align the strategy style to the market. And one of the most prominent edges that I talk about in this channel is the tendency of the S&P 500 to drift up most of the time. Now, once you find that edge in the market, you're going to face a problem, which is most likely your strategy just going to be lucky instead of a driver behind it. Because if you know the direction already, then you're just going to pick up anything and it should be aligned and the strategy will do well. So how do you know if your strategy is lucky or not? Now, this is not robustness testing. This is just to get a base of what luck is in this market, and our strategy has to beat that base. So this is the S&P 500, and like I mentioned, this market tends to drift up most of the time. And although I teach a different way to find out in my AlgoTrading masterclass, today I'll show you a simple example of how this market goes up all the time. And this is the random strategy that I'm testing on the S&P 500. So basically the strategy will buy, exit after 3 bars, wait for 12 bars, and buy again. That's it. It's always true. So we're always buying, exiting after 3 bars, waiting for 12 bars, and doing it over and over. So this strategy made 270 trades since 2007, 60% win rate, and $11 an average trade. No slippage, no commission. So it's losing a strategy, but it's not losing by much, since especially this is extremely random. Now, if I randomize this, so if we test from, let's say, 3 to 7, and the weighting 5 to 15 in step of 3. So I'll have 25 strategy combinations. And let's look at these results. So if I sort by return to drawdown, we can see that, even this is profitable. So 23 strategies out of 25 are profitable. And I just randomized the exit. So I'm always in the market. I enter, I exit after a certain number of bars, and I wait certain number of bars. But all of them, almost all, are profitable. Not only that, I have strategies like this. Look at this. 300 and plus trades, average trade of $472. So that is like, that's already a strategy. But how can that be? I'm entering like I just found this pattern randomly. So first, this is another proof over the one I did before that the S&P 500 tends to drift up all the time. Because if you do anything, just go long regardless, and you just control the exit, you are making money in the market, and you are making really good money depending on how long you wait and how long you hold. You can really have a good strategy. And no need to worry about indicators or about the patterns. There is nothing in this strategy. I'm just literally waiting and buying, waiting and buying. So let's pick the best strategy. So this is the best one, 5 and 8. And the randomness that I'm going to do is every time I reach an entry, I will flip a coin. If the coin heads, I will buy. If the coin tails, I will not buy. And then wait for the next signal. Flip a coin. The coin heads, I buy. If it tails, I don't buy. And then we wait for the next signal, and so on and so forth. So I am still holding 5 bars and waiting 8 bars, but every time I wait, I will flip a coin to see if I enter again or not. Before we test, I took a screenshot of this so we can compare what's going to happen next. So as you can see, 5 and 8 is the top performers, making $145,000, 308 trades, $472 on average. So now I introduce this percent. So if I put this at 50, that means it's a coin flip, basically 50-50. So you see now, every time I compile my strategy, we will get a different results here. So this is 288, $261 on average. And if I compile again, 287, $328 on average. And again, 287, and so on and so forth. So you see we're having a flip. So now I'm going to do this same one. So we will do 25 combinations, but now we will have the coin flip for every trade. So let me show you what happened. So again, this is sorted by return to drawdown, and we can see, let me bring this and look at the difference now. So the top one was 5.8, this is 3.8. And the top one was making 145, this is making 102. And if I do it again, and sort by return to drawdown, again, the top one is 515, making 122. It's not the same. So you see, it's random. I'm just trying to prove to you, of course, I know because I coded the strategy, but just to prove to you that this is using a coin flip. And every time I run it, it will bring new results. So now that I have the basis to do a random strategy, I need a big sample. And I'm going to look for about 50,000 strategies. So I can get the average of that to find out where the luck sits in this instrument. To get a bigger sample, I will randomize the weight bars 5 to 15 step 3 and the exit bars 3 to 7 step of 1. And the random percent, this is the coin flip, I will do it from 50 to 70 step 5. Well, 50 is half and half. And 70, that will yield more trades than not. So when I reach a trade and flip a coin, it will land ahead 70% of the time instead of 50-50. That's what 70 means. So basically we are giving it more trades than normal. And then I have some clever code to increase the number of coin flips, because right now with this we have 125 combinations and I want a bigger sample. So this will multiply that. So if we do, like, let me show you. If I do 100, you can see now I have 12,000. So if I do 400, that should give me about 50,000 combinations, which is what I want. So these are the results that I got. It's about 50,000 strategies. You see, this is the count, and these are the filtered strategies. So overall, I am about 28% in the market. And my return to drawdown is 1.6. And my average trade is $248. Win percent is about 60. 1.3 profit factor. And about 250 trades. Now I filtered the really good strategies, and you can see they're about 20% of the total. But interestingly, it's about the same number of trades, double the return to drawdown, and about double the average trade, but same exposure and about same profit factor. So what do we get out of this? Basically, we get the base strategy for the S&P 500. So your strategy in the S&P 500, it needs to be at least these numbers in order not to be just luck. I think that is the minimum that you should accept on the S&P 500. Of course, this will be tied to the exposure. So lower exposure, that means this number is lower. Because the S&P 500 tends to drift up most of the time, this test shows that your strategy has to pass a certain level to be accepted. So, profitable alone is not enough here. Now, this can be applied to all markets. Once you find the market edge, you can do random strategies like this, going with the market direction, and then you can find the base for that market, and then your strategy has to pass that threshold to be accepted.